The Securities and Exchange Board of India approved guidelines for spot gold exchanges at its board meeting on September 28. The benefits of such an exchange, according to a Sebi statement, would include efficient price discovery, liquidity, and assurance in the quality of gold. It is also expected to create a national pricing structure for gold. Despite being the world's second biggest gold consumer, India currently allows trading only in gold futures. The new gold exchange will compete with sovereign gold bonds, gold ETFs, and digital gold. Firstly, let us see how the gold exchange would work. The instruments representing gold that will be traded on the exchange will be called electronic gold receipts or EGRs. Any recognized stock exchange is allowed to launch trading in EGRs in a separate segment. EGR is initially created when physical gold is deposited with vault managers after assuring the quality of the gold. They are credited to the demat account of the beneficiary. EGRs can be held for as long as intended since they carry perpetual validity. And finally, an EGR holder can withdraw the underlying gold from the vaults by surrendering the EGRs. Now, what should investors keep in mind about gold exchanges? Let's talk to independent market analyst Ambarish Baliga to understand.
First of all, not all EGRs can be exchanged for physical gold. It would be only those cumulatively holding 50 grams or more of EGRs. And also there's a cost of conversion which the holder will have to pay. Secondly, though EGRs can be held indefinitely without conversion, there is a cost of safe storage charged by the vault manager, and that cost could be higher than what one would be paying possibly for a bank locker. And last but not the least, the investor will have to pay brokerage and STT while trading in EGRs, and will also have to pay GST while converting the EGR to physical gold.
We also have with us Sudhish Nambiar, Head of India Gold Policy Center at IIM Ahmedabad. He explains the implications of the new systems and how EGRs compare with other gold instruments.
Yesterday's approval from the Sebi board was music to ears for most in the trade, given that it's been something, a development that's been long looked for. That's kind of incentive structure is what is being aimed to build through a exchange type mechanism, where one would want to follow a quite a compliance structure, want to be part of an ecosystem that promotes trade in a more progressive basis. So that's one component, and the other would be the transparent pricing. So currently, is more of a bilateral trade that happens in the market. The bilateral trade and the pricing will be varying from city to city. It can vary. Various associations have various prices. So this is where, again, the spot exchange is going to play a critical role. And while we do that, it also provides a significant logistical convenience for the traders and for the jewelry manufacturers across the spectrum, across the value chain. We try to invest in gold, sovereign gold bonds, or the ETFs, or the digital gold. Now, somebody wants to buy something like 5 grams of gold. They want to accumulate it over a period of time. So this again makes a platform for accumulating gold through the spot exchange and taking delivery at the time what they want. So for instance, if you look at ETFs, you have the NAV price. Then and if you're looking at sovereign gold bond, typically during the primary issue time is where most of them would be buying it. And digital gold is the only platform where you get to buy it 24/7. But then on the digital gold, we are not sure who is actually holding those gold, where it is being held, because it's not working through a regulated environment. So it's quite possible that something like digital gold can also shift into may also use the electronic gold receipt as the as the primary backing of the gold that investors are buying. So that's quite possible. It might happen that way, and which actually goes on to provide good trust among investors that, see, I'm having my gold bought through this digital gold platform, which is being managed by a vault that is regulated by Sebi. When you're buying gold, you actually do not know what actually is the price. What is the market determined price? There's a landed price, and over which there's a premiums that gets added on. One would eventually try to pay something like 4 to 5% over the landed price, and but most of the consumers, most of the investors do not understand why they are paying. So through a market determined transparently discovered prices is where they get to participate, which is a big advantage for the investors. Because ETFs again is a on again is treated as securities, and sovereign gold bond that has its own benefits. If you look at, because anyway it's a government issued, and there's a good tax benefit that is being given on that front. In addition to it, you have 2.5% that you earn on sovereign gold bond. So we can't be directly comparing with sovereign gold bond. Just the fact that in this case you have a physical gold that is actually being held against the electronic receipt, whereas sovereign gold bond you don't have a physical gold. It's just the trust on the sovereign on which you are buying the bond. So that's it. So ETFs again, it's like when if ETFs are treated like securities, the same way the EGRs are securities. So the similar tax structure is what would apply in both the cases. Yeah, there's more liquidity. Further to that, there's price through the day. It's not just one price in a day.
Okay.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.